Please take your seats. The program is about to begin. Please take your seats. The program is about to begin. Please welcome to the stage Hanan Mohammad AlShehri, CEO of the Securities Depository Center Company, ADA, part of Saudi Tadawul Group, for a conversation with Bloomberg's Lulu Chen.
Good afternoon. I hope you all enjoyed lunch. So for our first panel in the afternoon, we're going to talk about capital markets and new developments between Saudi Arabia and Hong Kong. As we know, this city is emerging as a gateway for Middle East capital flow, and we're talking about the new developments and policies and what opportunities they bring. So Hanan, for starters, can I ask you to set the scene of what's happening in Saudi Arabia capital markets and the role that your firm and you play in it?
Thank you, Lulu. First of all, it's my pleasure to be with you here today. The sessions in the morning were really insightful and educating with a focus on the Asian markets. So it's my pleasure to share some overview and insights for my side of the world and our market, which is the Saudi capital market. And to start with covering briefly the Saudi capital market. So it has undergone a fundamental transformation over the past decade to evolve into one of the main emerging markets, globally speaking. The vision that we have, Vision 2030, which we have it on a national level, has been a main driver for this growth. And the vision has put the capital market and having an efficient capital market at its core for economic diversification and having the funding that the private sector needs. So our market today is sized at $2.6 trillion in terms of market capitalization. And to look at the Saudi market, we don't focus on the size, but the growth of the market overall. And this growth has been governed and driven by, I would say, three powerful engines. First of all is the supply side evolution. So again, the vision is moving, first of all, public assets or state-owned assets into the public hands. Aramco is a very good example, and then the logistics companies, etc. The Saudi market today is one of the top markets globally in the number of IPOs, which is something that I think we share with Hong Kong Exchange. The 2025, the Saudi market ranked #1 in the world, actually, in the number of IPOs. This is when it comes to the supply side. The second powerful engine is the demand side opening. And by opening, I'm referring to the change in the investor base in Saudi. The client base or the investor base have changed drastically from being a retail domestic market into an institutional and international one. The Saudi market was opened for foreign investors back in 2015. But at that time, there were stringent requirements for foreign investors to participate. We're talking about a minimum of $5 billion assets under management and a minimum number of years and experience in asset management. And the investor types were limited to banks and financial institutions. Fast forward, and the beginning of this year, our regulator, the CMA, have completely removed these qualified foreign investor requirements. Now the market is fairly open to all segments of international investors from all around the world. So this is when it comes to the demand side. Of course, with the inclusion in the emerging market indices, this played a critical role in inviting foreign investors and the increase of their participation in the market. Third is the debt market renaissance, because the equity market got the headlines for quite some years. But arguably, the debt market is as important. The government bonds and sukuk market paved the way for the corporate also debt issuances, which creates now two pathways for issuers to raise capital and come to the market for funding. So this is, in a nutshell, an overview of the market.
So you have the demand for listing, opening up to foreigners, and also developing the credit markets.
Yes.
In terms of working with Hong Kong, about 3 years ago, we saw this basket of policies, initiatives coming out from the two places. What are the developments since? Can you walk us through what's happened, and what should we expect next?
Right. So our partnership with Hong Kong Exchange has honestly moved from soft engagements to real connectivity. And this goes beyond having a financial and bilateral agreement. I actually one time came across a metaphor that is not far from reality, describing the movement that's happening now to the Silk Road. That has history of 2,000 years ago, where the Silk Road were to connect the Arabian Peninsula with southern China. Today, with these links and connectivities, we're not reinventing the Silk Road, but we're digitizing it in a way. So today, the ETF, the first actually ETF that covers the Saudi market, is listed in Hong Kong Exchange. And it's tracking a lot of interest from investors in the region. Vice versa, we also have an ETF in the Saudi market that links the Hong Kong Exchange and the China Index. And this is the foundation, I would say, layer to many more products to be listed in the local markets. And we see always this interest from investors in China and Hong Kong in our markets, and also from Saudi investors to the Hong Kong and Chinese market. PIF alone have signed, I think, up to $50 billion of investments in Asian markets, and have increased their presence of 3 regional offices between Hong Kong and China, which also follows the Silk Road metaphor of not being a one-way traffic, but it serves both for the mutual benefits of both countries.
And what about the connected listings?
Right. So the next steps to follow as things that we can do together is, of course, normally the cross listings. And we're looking at this together with the Hong Kong Exchange and our regulators, of course, of how can we realize the cross listings between the 2 markets. We have recently launched the depository receipt regime and framework, which can help actually of listing of foreign companies in the local market. So we have this path, and we have the classical path of cross listings and having links between the depository centers in the 2 markets to be able to list companies.
Now I know that you want to be careful when in terms of what types of companies can qualify for the cross listings. We mentioned Emirates as a successful example. Yes. What do you see as the type of companies that could become successful candidates for these types of listings?
So as an infrastructure and exchange and depository center, we do not specify a type of company or a type of sector per se. And the first approval comes usually from the regulator to list a company. Having that said, today our requirements for cross-listing that the company needs to be listed in its home country first. So this is the first check that we need to run over, and then the disclosures and being able to comply with the regulations in the Saudi market. This is, of course, another important factor.
Mm-hmm. Now, I have to ask about war, the impact in the region, and how are you seeing that affecting money flows?
Right. So with the unfortunate circumstances that the region have witnessed, an interesting actually observation we've seen in the market that there was an increased trend of foreign participation since the beginning of the year. And this hasn't slowed down with the war or the events associated with it.
When you talk about foreign participation, what is the definition of that?
When we say foreign participation, I mean how foreign investors they contribute to daily trades, and of course the ownership they represent as a segment of investors in the market. So this is something that was a positive actually outcome that we've been looking at closely, and it's something that indicates that foreign investors are here for the long run. They are looking for the long-term investment objectives, and they realize that the current circumstances are basically backed by a lot of fundamental evidence, a lot of operational resilience that the market has, and a lot of diversity in terms of opportunities. We have today in the market algo traders and high-frequency traders, and they're growing actually in how much they contribute to the daily trades. Today, we have them as they reached 30% of daily trades are being done by algo traders. And you would see that algo traders are pretty much sensitive to all the events that happen. However, having that said, it's still an upward trend of algo traders together with the foreign participation. So this is something that a factual actually aspect that the market have lived.
Interesting you mentioned high-frequency trading firms, because Hong Kong is one of those centers that attracts a lot of these firms. Is this also something that Saudi Arabia is looking at, and what kind of policies, infrastructure are you building in place to for these kinds of firms?
So absolutely, they are really playing a major role in increasing liquidity in the market, and we try to provide, from an infrastructural point of view, the tools that they need. For example, the low latency tools that they require to be able to execute, especially the high frequency traders. So this is something that we offer through our innovation arm, WAMAD. It's a subsidiary to Saudi Tadawul Group. And we see an increasing demand to these low latency services with the demand and the increase of the HFTs and the algo traders in the market.
And are you seeing a successful attraction for talent, for people who want to relocate to the region? Right. Has that been impacted in any way?
Actually, it was very interesting to hear about the talents and the different concerns around it in the previous panels, and the demographics as well. And this is something that I was hearing very carefully and thinking about the differences between the regions of the world in that matter. For example, the demographics in Saudi, we have more than 60% of the population under the age of 30. So this is something that is very powerful in terms of realizing the national economic development on a national level, you know. You expect these newer generations to be scientists and engineers to be able to keep up with how the world is changing, with also the AI and everything that we've heard this morning.
Yeah, 60% of the population so young. That would have huge implications in terms of how you develop policies.
Right.
And the economy model, which is very different from what we're experiencing in Asia and many countries. So for our people in the audience, if they are looking to tap opportunities from the Middle East, what would your advice be for people who are looking at the next developments, what to look out for?
Right. So we've been very focused in Saudi to tell our story, our growth story to the world. And we've done this and realized some important results that put our market very clear on the map as an investable market, as well as aligned in terms of infrastructure and policy with the international markets. So when it comes to the equity market, we worked, of course, on different tools that institutional investors usually look for. One example is adopting the omnibus structure. Omnibus structure is very important for the back-end operations.
And that's for efficiency of administration?
Yes, absolutely. So it's much easier, operationally speaking, to be executing trades in an omnibus structure. So this is something. Another thing is that we've seen a very, very uptick and increase in the securities borrowing and lending, and the short selling, of course, which follows normally. And it is adopted in the market in a way that it helped in the price discovery of the Saudi market. So it's something that institutional investors are keen to find in the market, and then we're making it available for our members.
On the short selling policies, what was the reason for developing these, allowing investors to participate in them?
So short selling is an important tool in any market because investors would invest long and short, and they have long strategies versus short strategies. I'm talking about asset managers, hedge funds, etc. So it's very important. Having a long market exposure is a bit limited for institutional investors. So it's a crucial aspect of what a market as an infrastructure can provide. And then on the debt market, which is a focus to us and our regulator at the moment, because we want to mimic the growth and the success story of the equity market, and we've done this. We've seen the trading activities have doubled in a year in the debt market. And if we consider the government Debt market, it is now, as I said, included in the JP Morgan Emerging Index, which is an important milestone that, of course, brings international flows into the local market. We are now also linked with the international depository centers, which is the access, of course, for foreign investors to reach our local market and not having the need to open accounts locally, so they can invest through their accounts in Euroclear, Clearstream. Another infrastructure improvement that we've implemented recently is the OTC trading in the debt market. So usually the debt trades are done over the counter, and this is something that was really well anticipated by the international investor community and have helped increase the liquidity also in the debt market. So these are the main points of developments that we've worked on in the market recently.
So overall, the trend seems to be relaxing rules and also development of different asset classes.
Absolutely.
Well, Hanan, thank you so much for your insights. Let's give her a round of applause.
Thank you. Thank you.
Of course, I have to give real consideration to the geopolitical dynamics that are playing out in terms of how we construct our portfolio.
Please welcome to the stage Sam Kellie-Smith, Chief Investment Officer and CEO for Asia Pacific at Jain Global, and Kenny Lam, CEO of 2 Sigma Asia Pacific, for a conversation with Bloomberg's Eric Schatzker.
Welcome, gentlemen.
Thank you.
And good afternoon. Ladies and gentlemen, a few quick words to introduce our panelists and establish some context for their remarks. This is quite obviously a conversation about hedge fund investing, and we are fortunate to have with us today 2 very different kinds of hedge funds. 2 Sigma is purely systematic, quantitative, data-driven, lots of AI, machine learning, and distributed computing. Jain Global, on the other hand, a multi-manager operation with 7 businesses, of which quant is one. APAC, interestingly, is another, alongside strategies such as equity arbitrage and commodities. Did I get that mostly right?
Pretty much.
Okay, good. I thought a good place to start is by attacking the premise of our panel. So here's the first question for our panelists. Is it getting harder or easier to make money in Asia?
Great question. So you want to go and then
Sam,
give it a go? I think generally easier. Making money is never easy. You know, different people make money in different ways. You know, we play largely relative value across a whole bunch of asset classes. But if you just look at, and we can kind of get into the premise of exactly why we built the fund the way we built the fund. When I started in Asia 25 years ago, you know, Japan had sort of come and gone. India really hadn't got going. Hong Kong had the warrant market. The IPO market had just, you know, it was actually a good time. It was a big bull market, but in terms of notional time spread and liquidity across, you know, the whole of Asia, very limited products, and really it was a kind of Hong Kong game at that time. It had been Japan 10 years before. Southeast Asia hadn't really got going, nor had India. You know, wind forward to today, between reval, quants, long-only back, domestic, retail, India, Japan, Greater China, Korea, Taiwan, levered ETFs, you know, deep, vibrant, long-dated option market, The whole of Asia is playing, and there are products to boot, which is what we do for a living.
Kenny.
I wouldn't say easier or more difficult, but I would say this. We are seeing a lot more opportunities that we could create alpha from. What that means is if you look at the two things we care a lot about, we care a lot about markets being deep, having lots of trading, great companies being traded. And you mentioned that we're purely systematic firms, so we're looking for data. And if you look at Asia, not only are we seeing more data that could be discovered for value, but there's a lot of structured, unstructured data. So for our firm, that's great. So we have to find a way to work on it. It's not easy to find a way to work with data, structured or unstructured in Asia, but that's where the opportunities are. So I would say there's a lot more opportunities than even before. I joined Two Sigma 8 years ago, and between now and back then, you already see markets being a lot deeper and a lot more data to work with. So that for us is great.
I'd like to come back to both those issues in a moment. Liquidity on the one hand, opportunities on the other. But before I do, I think it's worth exploring another point that applies to both of your firms. They chose to treat Asia as a nerve center, and to establish offices here with high degrees of independence and deep pools of talent rather than branch offices that are just order takers for bosses back in New York or London. The so-called global local or local global model. Why? What's the edge there?
I'll go first, Sam. Maybe a bit of context. You mentioned about our scale and where we are. We have a domestic PFM license in China. There are about 30 plus of them for global managers. We're lucky that we're one of the top 3 that's operating in terms of scale. We have invested a lot to build a domestic team that works in a very local way. Even though we're a global platform, we believe that if you look at Asia, I mentioned about data, it's not just about access of data, it's about context, nuances, and all of that comes from having deep local understanding, and you can't really fly in expertise. And that's why, however you call it, it's really just about understanding context in a much better way. I mentioned about unstructured data. Essentially what it means is put a lot of great context in a scientific way to the nuances. And that comes from that deep local expertise. We're still, step 1, 2 of the 10 steps we need to do to build that local practice. But yeah, so that's where we are. So we never believed that a model that only comes from New York would work in a global market like this. Yeah.
So, it's funny, I remember when you guys, I was not working at Jain Global because it didn't exist, but I was working at a US bank and in Asia, and I remember when you guys turned up.
Can you tell people where you worked?
I worked at Morgan Stanley for many years, and 28 to be precise. But I spent a whole bunch of time out here. Yeah. But I remember when you guys turned up, and it was kind of, you were one of the first crowd to turn up. It was you and Oxif, and there were a few hedge funds that actually did set up that kind of that Asia model, right? And then I think the US just became so centric around sort of investment returns. Kind of everyone went back to the US, and Asia definitely became, I think, an afterthought, an extension. And the way we look at life is, there's a whole bunch of stuff. Asia's a pretty complicated place, point 1. Point 2, it definitely needs a real commitment day 1. In terms of CapEx, that's tough to commit that type of capital if you're just pushing a pen in the US. But I think most importantly, it's pretty straightforward, right? People don't really want to bounce out of bed and love come to work if maybe they get to speak to their boss, once every 2 weeks at 8 o'clock in the evening. And so that Asia-US, especially for the US firms, and we're a US firm, that ability to manage a business, and I did that at Morgan Stanley for many years, both managing Asia businesses and having to deal with New York, and sitting in New York having to deal with Asians. And I don't know any way else we would have done it. I think to allow Asia to have autonomy is just so important for so many reasons, and very few people have done it. So it feels like a huge competitive edge, and you guys would agree with that, right?
You mentioned liquidity before, and I suppose there's no question that there's more of it available today than there was as you say, 25 years ago. But it does still come up as a barrier to scale relative to markets in Europe, certainly relative to the US market. What is the current state of affairs? You know, the HKEX is doing a lot of things here in Hong Kong to try to add liquidity to the market. Is there a material improvement?
Yeah, massive. I mean, I would say Europe is not an issue and not even competitive. So really now it's about the US, which is obvious, and we know that story well.
I agree with that. Sam.
You agree with that? Yeah. And then, no, if you just think about it, you know,
Dangerous amount of consensus up here.
6 of the largest stock markets in the world, after the US, are all in Asia. China's arguably the deepest bond market on the planet now. You know, the yen.
So no liquidity is no longer a barrier to capacity, no longer a barrier to scale?
100%. I mean, there's tons of work to do.
Okay.
Right? We were just chatting about, you know, the previous speaker. You and I were over there. You know, talking about short sell. You know, we could bring a whole bunch of that to Asia and, you know, across a whole number of markets, right? So I would say no. In general, across the whole of Asia, not fully developed, but liquidity now compared to 20 years ago, not even comparable. I mean, amazing, deep, very tradable.
I mean, I'll add to what Sam said. I mean, if you look at top 7 or 8 markets, I think 5 of them are actually in Asia, market cap. And if you look at our portfolio, Asia is about 20% of global trading. Japan, Korea, Taiwan, Hong Kong, mainland China, easily top in our portfolio, right? And so it's not really an issue of liquidity or depth. It's really now, you know, finding ways to create alpha.
And look, I mean, the other thing I might add to that as well is I would say, in general, and India's been probably slower than some, Korea's just starting to move, but in general, I would say there's a move from regulators, the industry, across banks, and alternatives, you know, the support groups that we use, but that communication around actually figuring out, you know, efficient price discovery, which is ultimate free capital markets where you can buy and sell, I think is getting like immeasurably better. So direction of travel, I would say, is quite powerful.
Maybe, Kenny, I start with you on this one. The surveys that I see, and I think some of our headlines alluded to this, indicate that hedge fund allocators continue to add exposure to Asia. Is there enough capacity here to satisfy demand? Or if the money keeps pouring in, do returns inevitably erode?
That's our day-to-day job, to make sure that we continue to create more capacity. And if you think about a firm like ours, the idea is that we need to have the best research to create the right alpha for capacity. And we are limited in capacity just means that we don't have enough research power to create that capacity. And so my role and all of our teammates is to make sure that we actually get access to that alpha. If you look at Asia, we have Hong Kong, we have Tokyo, and we have Shanghai. The teams are operating differently. So Tokyo, for example, is an engineering hub where we put a lot of engineers to make sure that we cover time zones. Hong Kong, we have research, we have data, and Shanghai is a very local team. All of them are aiming to do the same thing, which is create capacity. We would love to create more for our clients, but at the same time, we're careful in making sure that what we do is...
What are the constraints?
Talent. I mentioned about data. I also mentioned about, you know, market depth. Now, while they're great in volume and increasing by the day, we still want to make sure that the access is right. You mentioned about access to financing. All of that is something that's key. So that's something we need to continue to work on.
So Kenny looks at things and the question of capacity strictly through a quantitative lens. And you get to think about it in multiple ways.
Yeah, we look at it, we have a business, but tiny compared to these guys. I guess you probably have added transaction costs as well, you know, generally higher in Asia, which is a big component of the quant sleeve. We maybe differently get the benefit of also being able to trade global from Asia. And I think without a shadow of a doubt, I don't think anyone will push back. It's easier to trade the US from Asia than it is to trade Asia from the US. And you can see it's not just us. If you look across the Citadel Securities, the high frequency guys, you know, most of us are trading global. Everyone trades, you know, dollar rates wherever you are in the world. So look, I would agree with you. I think talent is definitely getting better, but definitely we don't have the talent pool. Maybe we have the kids coming out of school from China and India, but I would say of experienced talent, we don't have the pool that the US have. But no, I think, we asked ourselves when we set up Jain, why does the world need another hedge fund? Yeah. Actually, it was a real genuine question, right? And we very firmly came to the answer that there's tons of room, both in this part of the world, but also globally. If you think about the size of the balance sheets of the banks pre-crisis and how small actually the alternative universe is that's replaced effectively that risk-taking capability, is not even close. That's probably the one place where, you have, I don't want to say unlimited capacity, but I think in the alternative space, in the alternative trading space, yeah, huge capacity.
I mentioned that I wanted to come back to opportunities. Maybe you could tell me, Sam, how do you think about the nature of the opportunity set here in Asia over, say, the next 2 to 5 years? How much of it is structural? How much of it is cyclical?
Okay. I mean, we can get into, I don't know, memory cycle, is it cyclical or super cyclical or structural? So we're getting into the micro. But no, we made a definitive decision when we set up our Asia business that Asia was going through a structural change. And we're going to stick to that plan unless we had a really good reason to change it, but I don't think there is one. And then it becomes, look, you can't do everything. And so generally we think about, Japan, India, Greater China, Korea, Taiwan. That's largely. Yeah. We do other things outside that, but that's really the universe we play in. But you have to evolve. So out of the blue, Japanese power. Probably not something a lot of people in this room think about. That could be multi-year, deep, and really structural, right? And so we're also on the job.
Cyclical components to the energy equation at the moment.
Japanese power, probably not.
No.
You've got to turn toasters on, and power's actually a pretty constant thing. Maybe cyclical volatility around, it's moving around, or so you're right. I mean, there's a cyclicality to a lot of what we do, right? But I'm not, the real game, and I think you'd agree with this, Kenny, is we're looking for notional time spread.
Yep.
Then you have liquidity and cyclicality and vol and a whole bunch of other stuff, but largely, do you have notional? Is the spread? Can we figure out how to extract that spread? And we think very firmly in Asia that is structural, ongoing, and actually pretty early in the journey of Asia.
Kenny, how does Two Sigma adapt its systematic approach to cyclical issues like supply chain disruptions, for example, closure of the Strait of Hormuz, consequent impacts on liquidity and trading volumes in Asian markets?
We constantly find ways to improve our moat, and the moat comes from mainly two things. Not only access to data, but interpretation of data. So if you look at our data set, we currently have about 380 petabytes of data, and that's basically hyperscale in terms of how much data we interpret and we work with. Second is, we mentioned a lot about talent. We need to double click on that, right? Because talent, if you look at our type of talent, actually a lot of them actually come from Asia. But a lot of the peer firms, including us, our strategy is still relatively US-centric. And so we have to find a way to globalize, to make sure that we get the best talent anywhere. You mentioned about volatility, so back to your question. To address volatility, the best way is to make sure that your models, your research, your algo are consistently top of its game. And that comes from building a foundational layer that can be excellent in any cycles. And that's how we think, right? That's why we call ourselves as a systematic firm, is that we don't believe that there's one person or one bet that could really change.
What's the toughest place in Asia to recruit top talent right now?
Probably here.
Hong Kong.
Probably here.
I think here, Singapore, mainland China are great places to look at. Yeah.
So there's always been a competition for talent. And as a result, the best people are in relatively short supply, sort of a law of the universe. But Is any of that here changing with the restrictions the Trump administration has placed on foreign access to U.S. universities, and also the restrictions on work permits, and restrictions on immigration?
Yeah, look, I would say, I mean, he's the icing in the cake, if you want to. I'm going to, little personal bias here, right? But if you want to make America a little less exceptional, he's doing a good job. I think it was before him and it'll be after him. But in general, I think it's fair to say that the U.S. is still amazing. I spent most of my career there, you know, but I do think it's a little less exceptional. That's the way I would describe it, right? A marginal change can be absolutely huge if you get the right, you know, inflection point. And the talent is not going to Europe. So I think we're actually in a great spot.
Net beneficiaries?
Here. Net beneficiaries, I say, very much Asia, you know, at the margin. You know, you're not necessarily sending your kid to Stanford now. There are perfectly good unis here, and they're going here. You know, the margin, you don't need to go and join Goldman or Morgan Stanley in New York or Two Sigma in New York. You can come and work for an Asia firm.
How many people
I think absolutely right. U.S. is still by far the best in terms of attraction of talent. So we, even saying that we need to diversify, U.S. is still the core base. I do think talent themselves are diversifying. It could be one of those issues, but at the same time, if you look at universities in Hong Kong, they're doing amazing programs and great research.
China.
Right? China, Singapore, you know, NUS, NTS, they're great in many of the disciplines that we care about. And so if you're a talent, you're thinking, well, where should I put my next 4 or 5 years for a PhD program? Then it's not as lopsided as even 5, 7 years ago. So that's why for a firm like ours, you've talked about talent, then we need to basically go to where the talent is.
How many, for both of you, how many people would you say you've hired in the past 6 months whom previously you would have lost, you couldn't have had because they would have gone to the United States?
Great question. It's not huge, but it's marginal. It's real. 10%?
10%.
Of the crowd?
I can't put a percentage, but
And I would say some of those maybe have come from Europe, and you know, it's not like we didn't just get them straight out of
It's not binary.
a PhD program in China, but it's real.
But we're planning not just for the year or the year after or 2 years after. We're planning for the 5, 10, and we do see a structural trend where it has to be a global approach. It can't be a one place, right? So,
if you asked 100 traders where they'd most prefer to work and live, how many would say Singapore, how many Hong Kong, how many Tokyo, how many Shanghai?
Hong Kong for me. Why ask?
But you're not 100, you're you.
You sure?
I think it's 50% plus in Hong Kong.
Yeah?
And I'm biased to Singapore. I live there. I'm Singaporean, so I got to speak for my country. But I think Hong Kong is still a real hub. Shanghai, I think, undeveloped yet, to be honest.
Which?
Shanghai
is
undeveloped, to be certainly in our business, right? I would say Tokyo, less people now than actually 20 years ago, and Singapore on the rise. So if you want to kind of do the mix, I would say it's probably a little more mixed, but Hong Kong is still a big chunk of it. Singapore has definitely become, you know, macro and commodities, and actually some of the trading firms are in Singapore.
Well, Eric, you and I talked about this, right? Just before we were saying, look, Hong Kong, the vibe and all that's back. Part of it is, you know, I was born and raised here. The role that Hong Kong played for many years is a bridge for global firms to go into mainland China. I think the role has shifted, evolved to become not only a global hub for global firms going into China, but also Chinese firms going global. And so that unique role, it has become such an attractive position for talent, right? And that's why I think Hong Kong would be a good place. Not the only place, but a good place.
But by the way, you know, I think 2 years' time, you're going to have Mumbai or Delhi on that list.
Really?
Yeah, I think. I mean, you look at SITSAC, all the you know, so many people are now onshore in China. We're not yet. You guys are. Sorry, in India, you guys are not. But people are. I would argue more people in some respects are going onshore, India more than China in some respects. So I wouldn't write out. You know, I think India will be on that list at some point.
So that raises a question for me about India. Most people in this room, if they have any experience in India, could agree that equity market's expensive. It's crowded. Shorting, as we discussed, is very difficult. and costly, and there's a lot of domestic competition. So why be there? What's the case?
That's a great question. I mean, the case is we happen not to be in that business, but this is the case. Very, very deep, liquid, tradable market and a huge retail.
Yes.
And it's a pretty much captive audience, given how they deal with capital there. And so there's real money being made in the trading businesses. I think with respect to us, I mean, I actually just came back last week, probably next year's trade. The energy thing is real, the lack of AI is real. Foreign flows have been negative for each of the last 18 months, so that's tougher trade. I agree with you. Yeah, expensive market, funding short for probably a whole bunch of places, but very tradable.
I don't have a lot to say.
Yeah.
We are focusing on the markets we're working on now.
Occasionally, I like to help our audience learn from your mistakes. So I'd like you both to share with us your biggest screw up in Asia, what happened, why, and what did you learn from it?
Wow.
Way to
Wanna
ask
go
that
first?
the live
Yeah,
broadcast.
Thanks for that, pal.
Eric. I think there are many mistakes to draw from. One of them, I would say, I wouldn't say is a big blunder, but learning about operating really domestically in China is something that we have to kind of constantly evolve, especially in how we think about attracting domestic talent. Of course, we think of us as, we're a global brand name. We come in, we should be able to easily attract.
Should be a magnet,
talent.
right?
But you quickly learn that domestic leaders are great, and domestic talent are as attractive, if not more, to domestic great firms. So we have to make sure that we articulate our proposition clearly, why work with a 2 Sigma and not this great leader in the domestic market. And that, I think, is something that I would say we have learned the hard way in many years of operating in the market.
Yeah, so look, I wouldn't say it's necessarily a screw up, but I would say, thank God.
At least not saying it in public.
I mean public or private. We actually haven't had one of those, so that's good. But what I would say, which I think is maybe akin to what you were saying, is one thing we absolutely have figured out. There are so many rabbit holes in Asia, and you kind of want to go down them all. And I would say we've got much better at actually making sure what we do extremely well, and there's real depth. Then you go on to the next project, and which is very different from the US.
Pick your
right?
spots.
Pick your spots, and then to your point,
agree with that.
The domestic talent know-how is deep, and you got to pick your spots and do it well.
Ladies and gentlemen, Sam Kellie-Smith, Kenny Lam.
Thank you, Eric. Thank you, Sam.
Cheers, brother.
Please welcome to the stage Clara Chan, CEO of the Hong Kong Investment Corporation, for a conversation with Bloomberg's Stephen Engel.
Oh, bright lights. I'm not used to them. No, of course. Hi, everybody. Good afternoon. I get the 2:30 or the 2:20 afternoon panel just when everyone's back from lunch in a food coma. But hopefully everybody will be enjoying this lively conversation with Clara Chan, the CEO of the Hong Kong Investment Corporation. Just 4 years old, you deal with what they call patient capital, but I've lived in Hong Kong in and out for 36 years. This is not a patient city, right? This is a city of action. So maybe we can start by kind of giving an update on 4 years in. What has surprised you most about the investment climate? Because Hong Kong obviously has had, through the pandemic and through some of the political turbulence, sort of some confidence crisis. What has surprised you the most about your remit and how it's been performing?
Well, thank you, Stephen. Always glad to be sharing on the Bloomberg stage. From the HKIC's perspective, we started off, we were established in end 2022. But 2024 was the very first year of our full operation. But as you said, we basically have been through a great trajectory, seeing the bounce back of Hong Kong. The fact that Hong Kong bounced back is always well proven by track record. I think we have been through many different cycles in the past of different natures. But I think the speed and the scale of the bounce back is really a pleasant surprise of everybody. Just now the panel, I think people talk about how talents, how great firms like to have the foothold in Hong Kong as an international hub. So for us, we actually also see different dimensions. For example, setting off, we are charged with a mandate, due mandate. Not only bringing home financial return by investment, but we also want to bring new impetus of growth in upgrading our industry, AI applications, our future generations. We are very surprised, pleasantly surprised. Number one, the great pool of talents that Hong Kong have. Basically, people are all very focused on innovation technology. So in terms of investable space and companies, we see a lot. So good for investors because you have a very great pool of, I would say, companies and entrepreneurs that you could work with. The second part is what I think the earlier panel also talked about. Hong Kong is playing a great role in terms of being a super connector, bringing the Chinese mainland companies to go outside, but at the same time, it's a two-way flow. We also see a lot of good, high-quality, long-term capital coming to this part of the world. So to your point about patient capital, we think that we are not alone because a lot of other sovereign wealth funds, pension plans, they're also looking to invest for the long term, particularly in technology.
Well, technology has been a big part of the portfolio companies and projects that you've invested in. Does it get to the point when you see the frothy valuations in AI, but then at the same time, the story that was on the Bloomberg terminal today was about the National Development and Reform Commission, among other bodies in China, are talking about spending billions of dollars building out data centers across China. That would seem like a golden opportunity for Hong Kong, not only from the financing perspective, but also for an investment.
Well, I earlier mentioned the HKIC was set up in 2022. The reason why 2024 was the very first year of operation is because we spent a lot of time understanding the market and the sweet spot for Hong Kong. Because as I said, it's not only for financial return, but whatever we invest, whoever we partner with, we want them to bring benefits, long-term benefits to Hong Kong. So the reason I mentioned this is because when people were debating what AI large language model is about, we already invested in a number of them in 2024. When people talk about whether embodied AI is real, again, we already kind of put our bets into a couple of them. So give you some example. I think a few days ago, Financial Secretary wrote in his blog about a company called Galbert, which is going to operate Hong Kong's very first embodied AI convenience store in Hong Kong, in the waterfront of Hong Kong.
So what is it, robotics with robotic
yes.
making the coffee?
Actually,
what is it?
Yeah, well, making coffee or like selling different things, more like a full-fledged convenience store, but meant by embodied AI. So I think this is actually great for Hong Kong, and as I said, first of its kind in Hong Kong. That company, we invested in 2024, and throughout this trajectory, they already operate similar stores like in Beijing. So it's not a concept, it's a proven concept that we can touch, we can see, we could feel, and it's now in Hong Kong. And the other example I could give is, I think a lot of us in Hong Kong very pleased about our very first astronaut, Dr. Lai Ka-ying, right, who's now in the space with Shenzhou 23. And many of you also may be aware that she is bringing with her an innovation from the Hong Kong UST. Basically, it's an AI power, wind power, and weather forecasting like solution and also a monitor. She's bringing with her that and operating in this space. So that company is called Stellaris, and we invested in 2025.
What was your remit? Take me back 4 years, and how much leeway were you given on risk appetite? Because I would say in past, the Hong Kong government can be labeled as a bit conservative, but then you were given what was originally capital of 62 billion Hong Kong dollars, about 8 billion US. It's fully invested, isn't it?
Yeah, it's pretty much fully allocated
Fully allocated
Committed.
right now. We'll get to in just a minute whether you're going to get some more in the coffers. But what was your risk appetite then versus right now?
We see risk and return going hand in hand. But our sweet spot and striking zone, I would describe as we try to focus a little bit more on the space where we could find value for the future of Hong Kong. A few dimensions. Number one, if you look at the data we share, basically we invested around like 10% in really early stage, which is like pre-A round. So around 60% in what we call growth stage, which is actually ABC rounds. Basically early stage where we think we could bring value. The second point is about the fact that when we invest in those companies, those are bringing to us like cutting edge technology. We talk about AI, large language model, embodied AI, and now we're in areas such as commercial aerospace and also bring computer interface. And the last bit I would like to add is when we call patient capital, that patient is not just like passive, sitting there and waiting for return. What we want to bring to the table is, number one, not only our own capital. We always quote a number saying that the capital multiplier ratio for every dollar we invest in the company, on average, we are bringing in more than $8 from the international market long-term capital, like other sovereign wealth fund in the same company. So for us, the growth is not like sitting there picking the right team, but we also want to add value to them.
So again, I come back to if you're fully allocated with that initial investment in this fund, will you and when will you possibly receive top-ups, and from whom as well?
Well, the financial secretary already mentioned in his budget speech the fact that we're pretty much fully allocated or committed. And this concept is like, when we invest in early stage companies, as you said, return is good, potential is good, but we are very cognizant of risk, right? A lot of these like early stage companies, they may or may not work, even with our like best effort and everybody putting our heads together. So we need to have that professional and market mindset, how to mitigate risk. So the reason and the way how we do it is by a milestone approach. We identify the company, the sector, the team, and then we put a little bit of money. We try to test them out. We set the milestone. So the fact that we said is like fully committed is because by that milestone approach, we already committed to give them more, maybe 3 or 5 tranches more if they hit a certain like business milestone. So that's how we describe as fully committed. And to your point about so what next, basically, while we are on very good track in grooming the company and also bring financial return, the government financial secretary already mentioned in his budget speech in February that he is considering and discussing with us the capital injection. And well, I will leave that tough questions to the government in terms of how the next chapter of HKIC would be.
But you're managing the portfolio, so how urgent would it be if you see the opportunities right now while the market is doing pretty well and the returns seem to be pretty well, and you're well invested in growth areas right now? Are we talking this year, next year, or within a 5-year time
Well,
horizon?
for me, the urgency is always really because we see great opportunities in Hong Kong. And as you said, we need to act now, right? If you see the great opportunity, you don't want to miss them. But not missing them is not just because they could generate good financial return, but because additional benefits that they could bring to Hong Kong.
I'm going to put on my financial secretary hat here. I'm Paul Chan right now. Would you need 50% top-up, 25% of the original capital? What kind of top-up do you think would be adequate 4 years into this fund? Multiple funds. You have multiple funds.
Well, I would say that, number one, we need to think from the broader perspective. HKIC has been doing a reasonable job with a reasonable trajectory. But what next? Do we want to build with this platform? Is it financial return? Is it really also more like the international thought leadership? So if that's the case, so what is the best reputation, the brand that we want to build with the right amount of capital? So that's number one. Number two is, aside from the trajectory that we have been through, you may note from some recent announcement, there are new things that we are doing. First of all, apart from the individual thematic investment, the names that I have just mentioned that are coming to fruition, another area we also announced, we talk about launching of an offshore renminbi venture capital fund. So I think these are the new thing. We think we could go hand in hand with Hong Kong's traditional advantages.
How did you know I was going to ask that next? Because Paul Chan, again, in his blog post on June 2nd, talked about they're actively considering launching this offshore renminbi venture capital fund. How close are we to that? What kind of capital are we talking about, and where would that be deployed? I mean, I can honestly see, obviously, the further integration that we're likely to see with the Northern Metropolis and some of these initiatives that are going to be ongoing.
For us, we always want to add value in the way that we try to showcase and marry the traditional and emerging advantages of Hong Kong, the great attributes of Hong Kong. So the idea of having an offshore renminbi fund actually is a testament of both. The first part, Hong Kong being the biggest offshore renminbi center in Hong Kong, I mean, we actually have a very good pool, very deep capital in that sense. And what we do is to try to leverage this advantage to provide a better diversity of product. But on the other side, you asked about how close we are. And I could tell you it's very close because of the fact that it's not only a remote dream or vision that we think it may work. The reason why we propose it, in addition to Hong Kong's traditional advantage, is actually because when we talk to our peer investors in Middle East, in Southeast Asia, around the world, people are having high and high confidence of offshore renminbi. And actually, they have a lot of trades and transactions done in the currency. And at the back, of course, after getting the currency, they want to have a deeper and more diversity of product where they could deploy. And that's why when we say we have that idea, we already have that natural matching of the demand and supply.
So in lockstep with that statement is how much are your investment strategies in lockstep with national goals and initiatives from mainland China? Obviously, they do want to further internationalize the renminbi. So how do these investment decisions go in lockstep? And I mentioned Northern Metropolis. We've mentioned the data centers. A number of these different, money oftentimes follows policy initiatives. When the weight of policy comes to Hong Kong from Beijing, money follows. So would you say that the push for the offshore renminbi hub, which Hong Kong already is the largest in the world, further makes the renminbi more international?
How it works for us, I think it's also the beauty of the HKIC is we are a testament of the integration of a very proactive government and also a highly efficient market. Meaning that when we look at something, we propose something, we implement something, it's really a matter of how we see that would fulfill the dual mandate. Dual mandate, number one, as I said, financial return. So that's why we actually, it's always in consensus and dialogue with other peer investors because we speak the same language. And we look at like risk return, like macro, and a lot of these things in the same way. So that's the professional market side. At the same time, we exist for a reason. We want to build a better future for Hong Kong. So for that part, we need to really marry the professional and market insights and also that standard, that reputation, that brand, together with how to bring goods and bring things to the table for Hong Kong. And I would say that so far, we think those are very smooth integration and also implementation. Because as I said, look at like Galbert, Stellaris, these companies and different ARM companies. If they are not good companies by themselves, if those are only really policy initiatives, so how will we be able to have that capital multiplier ratio, bringing in other professional investors' money? So I think that's a real testament of how good these companies and how good the future of Hong Kong is.
How are you impacted? Not to go too micro, because you have a longer term horizon and you're not dealing with hot money flows across the border. But again, sentiment is a big issue and confidence for Hong Kong. How are you impacted with your decision making on your portfolio projects by the recent raft of regulation to kind of stem illegal cross-border transfers that have gone into stock markets, gone into insurance products and the like, and also simultaneous crackdowns or at least scrutiny of source of wealth of high net worth individuals in China?
As long term, professional investors across cycle, I think we always try to distinguish noise and rumors with facts and data. Being patient capital, we have that luxury to sift through cycles and also try to pick the themes, which could be bringing cross-jurisdictional, cross-generational benefit. So for us, as I said, even though whether it's policy changes, whether those are sentiment changes, but we need to really stick to our core on picking what's best for Hong Kong. The key thing, I would say policy would be interacting very robustly with our choice. It's really how Hong Kong government plan for the future. So if they say, well, these are the key industries that we want to bring Hong Kong into, or we want to accelerate the development, so definitely, those will be the area that we are very focused on.
But that's an area as well, you're diversifying, not just in high tech or hard or core technologies. You told me before this that you're going to be looking at investing in education.
Oh, yes. Well, so we talk about like thematic individual investment in the core themes previously, which was hard and core technology, biotech and health tech, as well as green energy. Gradually, we are pivoting towards also other sectors, including, as I said, offshore, renminbi definitely is that's financial services related, and also education, because the more we invest and in this role, we see the great future of Hong Kong because of the talents and the younger generations. So we definitely want to work more in terms of the education side, including, for example, student housing, which we allow to invest, noting Financial Secretary's budget speech, where he talked about our expected investment and curation of capital into commercial real estate in Hong Kong.
Can you give we only have 15 seconds left. This went by fast.
Yeah.
Can you give me an indication? You talked about returns. It's patient capital, so your time horizon is a little longer than some here in Hong Kong. But we haven't gotten the number for returns for 2025. We did see 2.34 billion in profit earned at the HKIC in 2024. We're going to get the annual general report coming soon. Can you give an indication of what, as Paul Chan talks about, double-digit returns for 2025? Is that 10% or 99%?
So I'll borrow his words, like double-digit return, and save the secret for the announcement of the annual report, which is coming online pretty soon, I think end of this month or early July. But I would say that it's a pretty decent number where, notwithstanding our due mandate, even if we compare that with professional market standard, we actually beat the benchmark.
Clara, thanks so much. Everyone, please give a round of applause to Clara Chan, the CEO of Hong Kong Investment Corporation. We could do another hour, couldn't we? Thanks so much.
Thank you, Stephen. Appreciate it.
Thanks.
Thank
Please welcome to the stage Yimei Li, CEO, China Asset Management Company, for a conversation with Bloomberg's Min Lo.
Hi everyone, thank you for sticking with us for this afternoon session, our conversation with Yimei Li. She is the CEO of China AMC, which is the largest ETF fund manager in China. Thanks, Yimei, for joining us. I just want to start with the latest news flow we are seeing today, right? The market is really concerned about this AI sell-off that is led by South Korea. And yes, granted, China is weathering it a little bit better, but what is your outlook on Chinese AI?
Well, I think we are still quite optimistic of the whole industry and the growth that are actually starting to take off. So this is not, from our perspective, a short-term bubble. We felt like this time around, well, everyone will say this time is different, but we really need to look into the earnings and performance and fundamentals to know if there's a concrete performance and fundamentals that are laying out for this AI and technology upgrade. And we all say that this is a revolutionary forces. So from we have seen on the ground, we do believe that the fundamentals are starting to be there already. And our portfolio manager joking about it, well, as the price going up, all the stocks are getting cheaper. So definitely the earnings are showing the signs. So we are still quite optimistic. And we have seen that really the market has been quite volatile, but you have all observed that the whole supply chain are getting very strong.
I just want to challenge that a little bit,
sure.
because we do see a bit of concentration risk, right? I think last month's data showed that the top 10% of stock is driving 60% of turnover. Is there any sign of pockets of equities looking a little bit overheated?
I think overheating certainly is there. I wouldn't deny it, but every trend turns out to be overheating in the process. And for an active fundamental researcher or portfolio manager, I think our job is to determine this overheating process on just managing the risk along the way. So where do we see actual bubble is overheated, or do we see that we have concrete numbers to back them up? And up till now, we think there definitely will be overheating process going forward, but risk management need to be very cautious where we can determine when is a good time to get out.
So could you be a little bit specific? Where are you looking at, signs? Where are you seeing signs of overheating? You did mention that this is a stock pickers market. It's not a time to invest broadly in index tracking funds.
Well, I think, in the beginning of last year, we definitely have seen great index products to be very rewarding. And this year, I think active equity stock picking really starts to show the color, and we have really good returns. Like in the past 1 year, maybe 100%, 200% return from our active equity. But what we are looking at is the scaling game is still working. So the scaling game for large language model, the scaling game for all the computing technology is still going forward. And we need to be cautious when that scaling process is slowing down or even stop. And that is the whole cycle probably coming to a plateau. And then the whole growth story probably will pivot. And that's when we probably will be very cautious.
I want to ask about the geopolitical risk that we are seeing, because the US had been tightening scrutiny over there. For example, they are barring mainland investors from participating in SpaceX IPOs. And then you have these big tech firms that are being blacklisted. What sort of challenge does that pose to your business?
Well, certainly, I think, barring investments certainly will deny a lot of the accessibility. At the same time, we still is a firm believer of globalization, and we are very strong behind the support of cooperation between two countries, or even, a larger global technology community as a whole. So we are trying to actually launch products, actually to unify the different regions and different supply chains. So last month, we actually launched a product on global AI in Hong Kong. So we are trying really to give people a holistic view instead of just looking at China separately and then looking at US separately. We hope that we still have a holistic perspective and investment tool to actually gather all the supply chain working for our investors.
Yeah, speaking of that, I know that China has some caps, right? We all know China has caps on the QFII sort of capital. And I understand your company is coming up with some innovative products to really bridge that gap and allow investors to tap into international equity. Could you just tell us a little bit more about these new products?
Yeah, thank you. We actually still think that the regulators in mainland China and the regulators in Hong Kong are working closely together actually to provide more accessibility to the market. Actually, just yesterday that the Hong Kong officials in Beijing held the press conference saying that they probably will enlarge the connect in the financial instruments in the Greater Bay Area. And I think that's a great tool that domestic investors can use that to invest in Hong Kong's product, and with that, an extension to international products. And at the same time, companies like China AMC, we are trying also to launch more products internationally and also serve as sub-advisory to different products worldwide. Like we have a product in Brazil, in Thailand, we have 3 products in Canada, and last year we launched the CNQQ products. It's like the Chinese version of, QQQ in NASDAQ. So I think accessibility really matters, and then we as a portfolio manager and fund manager should be proactive.
Yes. When it comes to ETF, which is China AMC's specialty, right? In China, this is still a relatively young industry, and in terms of the product mix, it's not as diverse as, say, in Hong Kong, where you have leveraged single stock ETF, actively managed ETFs. Tell us about some of the innovations you're seeing or you're creating in that space, because I understand you're working with index builders to create more specialized ETFs.
Yeah, we call it active indexing, even though we don't really have active ETFs yet. But our belief as the largest ETF provider is index always the key, is the fundamental, what investors are actually investing. So how do we express our fundamental views through indexing, through how to composite the index, I think is the number one question that we need to answer. So with the market is changing so quickly and the supply chain also is changing very quickly, we try to modify the index to keep up or to even guide the investors to different sectors, to the market. So in China, I think we are never saying that we are a passive investor in ETFs. We are actually very active in creating index and then constantly optimize the index to really keep up with the whole changing of the technology.
And in China, we know that people are compulsive savers.
Yeah.
What are you seeing in terms of retail flows? And are you expecting more of this deposit migration into equity investments, into ETFs?
Yeah, I think this whole deposit migration really starts to going to be the best opportunity for China's asset managers to ever have seen in the next 10 years. So we have this term of deposit migration that because the interest is so low in China, and even though people originally really keep their savings in real estate or in deposits, they start to reaching out. And this year we have definitely seen products like, we say like balanced funds or fixed income enhanced type of funds really start to attract attention from retail investors or deposit savers. At the same time, FOF can also provide like TRFs and low risk type of products really attract more attention from investors. I think migrating to equity or ETF will be a long way to go, but the trend is start to picking up.
So speaking of interest rates, what is your outlook on whether the PBOC will loosen monetary policy further?
Well, we didn't really see much of the window probably to lower interest rate in the near term because with the economy in the first quarter to be quite satisfactory, I think, well, the PBOC and the central government really sending out quite optimistic looks. And our projection for the A-share earning this year will be nearly 10%. So with that, I think, well, the monetary policy will still provide a quite comfortable range, but at the same time, I think the interest rate probably will be like the secondary instruments they will consider.
Yeah, we have been seeing this improvement in earnings this year, right? Especially when it comes to onshore stocks. But what is your outlook on some of these blue chip names that has been lagging behind quite significantly?
I would say it's a good time if we're long-term asset allocator. So we are actually very actively to push insurance companies or even our social security fund actually to allocate more, especially at this time, two large blue chips as dividend type of driven product. Because at this time, really, they are quite a good bargain already.
Okay, let's expand to the global macro environment, because now we have expectations of a Fed rate hike. We have all these geopolitics news coming out of the Middle East, oil prices in focus. What do you think is the most important factor that would be shaping Chinese markets in the second half?
For Chinese market, I think because it's so large, and then definitely we have seen in the past several years, the new economy really is picking up and booming. I think a lot of the investors are more interested in China right now because of the whole trend behind, DeepSeek and then all the innovations coming along. But at the same time, because China's economy is so large, and then we don't really forget the traditional side of the business, right? The traditional economy. So for China, even though the geopolitical tension outside is very volatile, but we have a lot of, domestic, work we need to be done, especially around the domestic consumers' confidence, the spending on consumption, and also how we are going to start to really push back on the job of real estate. So these, I think, are still mingled in our investment minds, and we need to be very active in reacting to the numbers that are coming out on the second quarter.
And we actually just got the inflation data out today and the trade data yesterday as well. And it still shows this bifurcated economy, right? Consumption is still lagging.
Yeah.
Do you think we should be prepared for still quite a prolonged slump when it comes to the consumption names?
I think the multiples really needs to have time to kick in. So we have a better performing stock market. We have people have better returns on their financial investments. We have a lot of the new economy that are earning better returns. And that will circulate back to the consuming and consumption side. But it really takes time. Like multiples need time to actually
How long do you think?
Well, we had a more optimistic probably, in the fourth quarter to see, things are starting to panning out from, the beginning side to be the multiplier into the end. But there are consumer names currently, I think, doing better unexpectedly, and we need to be more focused on new economy at the same time, how that will really influence the consumer side.
What are you seeing in terms of global capital flows now?
Global capital flows, well, we experience a lot of inflows in our products through QFII, and also we are looking at more interested in domestic equity from international investors. But I would say it's still more concentrated on the transactional side from the international investors. So the asset allocation investors are not coming yet as strongly as we probably have expected or have seen in the past. So I would say it's still early in the terms of international money coming into domestic market. But certainly, I think people are starting to show more stronger interest.
What do you think it would take to attract more of these global investors to come into the domestic market?
Well, the current story is still the technology upgrade. But I think I also understand that, like what you mentioned today about the traditional side of the economy, and certainly international investors are more concerned with those type of investments. But we do think that we need to show a different side of China. And then that probably is the first step. And we think the economy is a cycle. And then like the flywheel is already moving, starting from the new economy. And the flywheel, once it started, I think it would just probably amplify a lot of different aspects of the economy.
We have to talk about the latest regulatory crackdown when it comes to outbound investment. I'm just wondering, do you see any direct impact of that on your business?
I would say it's probably a plus for my business, because originally, I think people have different ways in investing overseas. And of course, I think currently it's just a regulation. It's not really tightening, but it's more demanding more compliance with the regulations that already were in place. But at the same time, we've seen that people starting to use more QDII product to invest overseas. We've seen that people have more requests from our Greater Bay Area Financial Instruments Connect. We have seen that people start to talk more about the ETF Connect project as well. So I definitely think, once those loopholes were sort of sealed, I think the formal channel will be more open. Yeah, so that's my judgment.
Okay, so might be good for your business.
Yes.
You are one of the first movers when it comes to tokenized assets, especially when it comes to tokenized RMB assets.
Right.
Tell us more about the products that you have and why should investors be looking into these alternative assets?
We at China AMC, we are very proud to be the innovator in this area, and also with the guidance of the Hong Kong MA and also the CSRC. And I think tokenized product is more like our way to put concept into proof. So it's not just how investors should transform their traditional investments into tokenized products. It's our way to build an infrastructure so that once digital assets start to kicking in different areas, different regions, different business scenarios, there will be readiness in the infrastructure for tokenized investments. So that side, I think at this time, we are still exploring. We have already finalized, tokenized money market fund in both RMB and Hong Kong dollars and also US dollars. We also have the first tokenized gold ETF ready. So in that sense, we want to be a bridge between the traditional investment instruments and the tokenized digital assets to link them together.
All right, thank you so much. We are out of time now, but fantastic conversation, Yimei Li, CEO of China AMC. And for those of you joining us online, that's it from us at Bloomberg Invest Hong Kong. But for those of you who are here in the room, as well as for terminal subscribers, we have Bloomberg World First coming up, a live recording of our podcast Odd Lots with our very own Tracy Alloway and Joe Weisender. So thank you for staying with us. That's coming up next.
Thank you.
Hello and welcome to another episode of the Odd Lots